Mohamed El-Arian, who, of course, is chief economic advisor at Allianz and president of Queen's College at Cambridge University. Mohamed, how much tougher is it going to be for the Fed to cut rates at this point?
I think it's going to be as tough as it indicated earlier. We're not going to get more than 3 cuts this year, and we're probably not going to start this cutting cycle until June. The market had gotten carried away, and yesterday, a relatively small miss in numbers that are very sensitive to seasonal adjustment created this outside-sized reaction, and it just shows you the extent to which the market had gotten carried away without much critical thinking about a very soft landing, many cuts, starting early. This was, I think, just a wake-up call to people who got carried away.
The very important thing about this whole situation in that CPI yesterday, the very important thing is what just happened. Well, March is done. Like there was still some people that were like, maybe in March they start cutting. That's out the window now. After the CPI number, now the thought process goes to May. Maybe May they start cutting, right? And as I tell you guys, I'm not in a rush for them to cut. Usually when the Fed starts cutting, it's usually not usually great things for the market moving forward after that. So I'm in no rush for them to cut, but it is coming. And it looks much more probable that it's going to be May. And March is, I would call it, a little bit more of a far-fetched dream at this point in time in terms of the Fed cutting in March.
We did see markets kind of quake, at least in the instant reaction to it. Yields moved pretty significantly higher. You saw equities sell off. But you're still talking about the S&P 500 and the Dow down by less than 2% from their all-time highs. And as Joe was pointing out earlier, that may be a reflection of how strong earnings have been relative to expectations, too. So is there a way for the market to continue to climb even if the Fed does not cut rates?
Yes, there is a way, and it has to do with the strong economy. It has to do with earnings, and it has to do with the extent to which the U.S. is exceptional relative to other parts of the world. This is more an issue for the fixed income market than it is for the equity market. And the fixed income market has to realize 3 things, Becky. One is service disinflation is really hard. We're not going to get it as quickly as we need to get to 2% as fast as the Fed wants to get to. 2 is that there are genuine analytical questions about what is the neutral interest rates? What's the right inflation target? How fast should you get there? These are serious analytical questions. And then the third element is that different parts of the economy differ in how sensitive they are to interest rates. And the market has to realize, the fixed income market has to realize these 3 things. And I think they got it. They got the message yesterday, but they overreacted because they hadn't thought about it enough beforehand.
This is the scary way that recessions come about, isn't it, Mohamed? And I'm not saying there's any similarity to the Volcker era or anything, but to finally get it under control back then, and it's not similar, I know that, but you had to cause a recession to get it under. So it's almost like the rates didn't go up enough. This is a strong economy, as you say, relative to the rest of the world, but they may need to do more work in terms of slowing that. They may have to basically cause the slowdown to get inflation where, and that's maybe a recession would never happen if it wasn't actually caused by central bankers trying to cool inflation.
I mean, that's the risk, Joe, clearly. But to be fair, and I've been very critical of the Fed, they started late, they made all sorts of forecasting mistakes. But to be fair to them, they've done what they need to do. The problem is the marketplace. The marketplace embraced last November, December, a totally unrealistic path for Fed cuts. Remember,
they told us so, Mohamed. They let the market believe that with their stupid dot plots, right?
Although their language was very different than the dot plots.
Yeah, the dot plots told us 3 cuts. The market, for some reason, embraced 6 to 7. But where they failed, and I agree with you, is on communication. That communication has flip-flopped. It's been poor. But this is not a Fed issue. This is a marketplace that got carried away and is now adjusting. And the risk is, as you point out, that the marketplace adjustment may pull the rug from underneath what is an exceptionally strong economy and one we should be proud of.
Well, so let me push back against Mohamed here for a minute. Is the market even adjusting? right? Is the market even adjusting? Let's pull up stocks here today, and let's see if the market's really even adjusting anything. We had one down day yesterday, right? Let me look at my stocks. Overwhelmingly, definitely green today, including, look at Fubo, 6% move, Planet 4%, Revolve 4%, Palantir 4%, SoFi 3%, Shopify about 3%, Baba's up. Meta's up very nicely, 2% move. Mattel, Nordstrom, Tesla, Amazon, Wynn, Nike, PayPal, all green. And the worst stock is like negative 1.7%. Let's pull a big tech watch list here. That looks like a lot of green to me out here, right? Oobity Booba stock. Wow, big move for Uber today. Congrats, Uber shareholders. 12% move. Netflix up. AMD up. Shopify up. Salesforce having a great day. Snowflake. I mean, the big dog Apple's having a bad one, but outside of that, it's a lot of green out there. So I'm just not so sure about this the market's readjusting because it had one day, right?
Trying to figure out is there were a lot of sectors and a lot of people that were counting on these rate cuts to refinance, whether that be in commercial real estate, whether that be in other projects that are totally sensitive to interest rate issues and things, that either need to be refinanced or you're going to lose. Those are the people who were really praying and counting on these Fed cuts coming sooner. If it doesn't come till June, is that the sort of thing that causes a recession when all of a sudden you have a lot of bad loans that can't get redone?
Listen, holy smokers, this is no joke. Okay, listen. The Fed, everybody that thought maybe the Fed's going to cut in March or April, right? 25 basis points. 25 basis points is not going to move a recession or not. If there was going to be a recession with a 25 basis point cut or keeping it 25 basis points higher, there was going to be one regardless. That had nothing to do with it. You need to move interest rates several hundred basis points to really get it to affect the economy in a substantial way. Okay, that's the bottom line with that 25 basis points. Are you kidding me? Literally, that's literally like nothing, like 25 basis points. So if recession hits, it was coming no matter what, whether they lowered interest rates 25 basis points or not.
Extent, or is that just going to be a situation where some people are losers and others step in and get really good deals as a result?
I think it's going to be the latter. I think we have a stock problem. Undoubtedly, Becky, we have a stock problem. We have a whole host of activities that were funded at artificially low interest rates and that are today unrealistic at the valuation that the owners think they should get. And that's going to be an adjustment. And you see it in commercial real estate. That's the leading example, but there are other sectors as well. So it's a stock issue. But the good news is that there's lots of money on the sideline waiting to engage at lower valuations. So we can manage through this as long as it is not too disorderly. I don't think in itself this is high recession risk. Where you get to a uncomfortable recession risk is when you combine the stock problem with the fact that the household buffers, this excess savings they had developed, were drawn down last year, and then add on top of that a global economy that is slowing down significantly. That is where the recession risk comes in, but I think it's less than 50%.
Wow.
If you hear things like we've heard
recession
the last
risk less than 50%, that's a pretty big statement there, right? And the thing that everybody needs to factor in that I don't think enough people are factoring in, that I think is very important in this whole story, is real wages. Real wages were going down for several years and then kind of flatlined. Just very recently, real wages have started to tick up again, which is very, very helpful to a lot of folks out there that have been, let's call it in the brackets of kind of struggling because of inflation slicing and dicing them and their wages not keeping up. Finally, inflation has started to chill out, as we all know, right? Really over the last 6 months. And meanwhile, real wages are starting to tick up in a good place. And so that's something I think a lot of people need to factor in that we just didn't have working for us for several years, to be honest.
Is Airbnb and Expedia both saying that consumers are slowing down? They're not back into this revenge travel like they used to be. Growth rates are getting back to normal levels. Will growth rates at normal levels in all areas of consumer activity be enough to continue to propel the market?
It should be. I mean, we were at remarkable growth levels. Third quarter, almost 5%. Fourth quarter, 3.3%. We were an outlier compared to the rest of the world. we're going to slow. Undoubtedly, we're going to slow. But I don't think we fall into recession unless we get some sort of disorderly financial adjustment or the Fed makes another policy mistake. There is inherent strength in this economy, and that inherent strength has carried us through some pretty difficult geopolitical and political circumstances.
What would your idea of a Fed policy mistake be at this point?
Well, before he answers that, I would love a more normalized economy. Listen, I'll tell you what's not normal. You know, the fact that you could try to call landscapers up and, you know, you want to do your lighting for your front yard, and it's hard to even get people to come out to the job site because they're so busy. That's not fun, right? You know, to try to contact pool companies and they don't want to, you know, even contact back because they're so busy building so many pools because there's been so much money in the system, right? That's not fun. And you can go industry by industry, like, you know, I think that because usually people are kind of fighting for your business, right? But I can tell you over the past few years, it really hasn't been like that. A lot of industries have just been in such a position of power that you as a consumer, you kind of look out there and you're like, man, I remember the old days when, you know, which wasn't that long ago, let's just call it prior to Rona, when, you know, there was demand for products, but it wasn't so overwhelming that people were so busy that they took things for granted, right? And I think that's a lot of what we've had over the past few years. So, you know, I don't think that's the worst thing.
So, for example, if they remain too
recessions are, I'll explain that in a minute.
That is now the policy mistake, that they are so scared because they were late, because they communicated poorly, because their forecasts were wrong, that they've been so shaken up that they end up staying too tight for too long.
Well, what's too long if you already think a Fed cut is not coming before June?
No, June is fine. But
okay.
If, for example, we're having this conversation in September and they haven't cut yet, then I think that will constitute a policy mistake. Look, I've been with you consistently for at least 6 months saying we're not going to get the sorts of rate cuts that the market had priced in, and we're not going to get it as early as March. June and 3 cuts is much more realistic. Now, if the Fed delays much longer than that and doesn't come through with 3 cuts, then that would be the policy mistake.
So I have a view on recessions. The recessions are really, really good, actually. And the reason I have that viewpoint that recessions are very good is they're so necessary in the system. And the reason they're necessary is recessions give everybody a moment to be very thankful and grateful for, let's say, having a job, for having a business, for being able to make money, those sorts of things, right? When everything's just so good for so long, you start to take a lot of things for granted, right? No different than, have you ever wondered why are we designed as humans to get sick? Have you ever thought about that before? Because we could have been designed to never get sick, right? And just be perfectly healthy all the time. I believe, and also you got to ask yourself, why do we go through tough moments in life, right? And I have asked myself those questions a lot of times in the past. And what I came to the conclusion of, things like getting sick, things like, you know, going through tough things in life and struggles and those sorts of things, they make you appreciate the good times so much better. You ever been super sick, you know, you had the flu super bad or something like that, and you just feel like death. And then, you know, once you get better the next few days, it's just like the sun's hitting you a little different. It's just like, oh my gosh, life is so great now, right? I think that that's a big part of it. And so the recessions are very similar to that. It keeps everybody at bay from getting too overly, you know, optimistic on spending money, taking out loans, those sorts of things, and also brings people back to a grounded reality of, like, you know, it's not always unlimited demand out there, and you know, you gotta appreciate what you do have for a business, for customers, for a job, those sorts of things as well. All right, guys, let's get into this.
Right. I wonder how much we tend to use the number 8 million aliens, illegal aliens, legal aliens, immigrants, whatever you want to call them. But I think that they've been a major source of rent increase because we have to shelter everybody. And the cost of sheltering is just going up because we've had a big burgeoning in population. We just don't talk about it. I think we should talk about it because it's something that is vital to make sure that we're a civilized country. And we right now have to put people in homes. And we have to put people in apartments. And we have no choice. And I think that's moving up shelter.
kind of ties in with what CBO said the other day about immigration, Jim, and that is that the economy is going to be $7 billion bigger because of the people we're letting into the country.
Well, look, these are undocumented immigrants. I think I do not share the negativity about this, by the way, because we have such a shortage of workers. And I think if we just adopt kind of a humane approach and also legislation in Washington, we will be able to make it so that everybody's productive. But in the interim, we have to shelter people. And I think that this big influx of undocumented immigrants and documented has made it so that we have no choice but to have rents go up. I actually think home prices will not go up as much. Again, I want to emphasize, I am not in the camp which just says this is something that is bad we have to take care of. I think it's just something that if we address, we can actually make it a positive, Carl. So I'm not as negative as everybody else is about this because I think that number can come down.
Meantime, David, apparel got some help, down 7/10. Gasoline was a help. Used cars, but then you get motor insurance, auto insurance.
Yeah,
up
auto
another
insurance
1.4.
was one of the biggest as well. I think we all sort of experienced the sticker shock of that.
So, something weird about that housing number, okay, something very strange about it, is I do wonder, and this is not very clear, but let's say, for instance, a lot of apartment communities have started to do some things, I would say over the past 6 to 12 months, where they'll give you, a free month either at the beginning of your lease or the end of your lease or the first month half off and those sorts of things. And I do wonder how much of that is even plays into the numbers, or are they just going off of the baseline, like how much that rent is for the apartment each and every month, right? Because that's another factor. It's like it should be considered, and I'm not 100% convinced, let's just put it that way, that that's even ever considered, just to be quite frank. If you pay $1,500 for an apartment, even if that apartment, let's say you get the first month free or something like that, I think it's still calculated as $1,500. But literally, if you took that over the course of a 12-month span, it's actually less than $1,500, right? Because you got the first month free or the last month free or something like that. So, I don't know. Those are things I think about and I consider, and I'm just not sure, these numbers really reflect it. But then again, no one ever trusts these numbers fully, so I guess that's nothing new.
I mentioned home insurance, which I'm not sure is a part of it, but which is going up dramatically across the board. Jim, it certainly seems to be diminishing the market's hopes for a rate cut anytime soon. I think the chances now for a rate cut in May, we don't even talk about March any longer, of course. When we came into this year, that seemed to be still on the table, at least as far as the market was concerned. What are your thoughts, though, when it comes to potential rate cut, not to mention our conversation from last week, which is not a hard landing, not a soft landing, but no landing?
You almost said rate hike.
I know.
You didn't. You cut it at the last minute. You called it the rate cut. But look, the economy's really strong. There's just a huge amount of money coming in from infrastructure. We're having a hard time finding workers in a lot of different businesses, whether it be engineer, construction. Housing is much stronger because mortgage rates drop. The rent number's not good. The food at home number and the food away number, I'm finding those hard to believe given the fact that Walmart and Costco have held the line on food. We had Coca-Cola this morning. That is a calm number. We had Molson. That is up. The numbers are up there, but that has to do with problems with Bud Light. But I just think that in the end, if we're going to measure everything on rent, then we're going to start believing that there will never be rate cuts. And that's not true.
Did you see Bud Light at the Super Bowl trying to do, different advertisements, making themselves look cool? They balled out for that, man. They hired a lot of big name celebrities for that commercial, and then after that they broke to it, and it was like Post Malone and a bunch of other people all happened to be drinking Bud Light. It was like, dude, did they pay the network like some big money for this? Because it seems like it.
I think that I felt that a May shouldn't be on the table because I just don't see any weakness in commerce in this country. We don't have we do not have price increases, David, like we had, but we do not have a cessation of price increases. Those who are looking for that will be disappointed.
Okay, so an appropriate market response then thus far this morning? Obviously, we'll see how we open 26 minutes from now.
Yeah, I think so. I think that we've been inappropriate most of the year because there were so many people who were thinking soft landing, so many people who felt that there could be a March. People put March, they put May, but they never look at the actual numbers. I mean, there are enough numbers in this CPI that are not the way they want to go that I think Jay Powell has been correct by saying, let's wait and see. And a wait and see number says, look, we would like to see rents come down because rents are integral. People have to have food. They have to have shelter. Food and shelter were not good in this report. I think food will be better. I think it might make time for shelter. Carl, look, we've had a big influx of people. And I don't know why a big influx of people would ever be considered negative or keep rents the same, because that is a rental group. And I just think that they're not talked about because I don't know how it became taboo to talk about all the people who come in, because I think that it's necessary to calculate what they've done with rent, because it's obviously substantial.
So Kramer's got a good point there. It should be absolutely factored in, 100%. Because it does have an effect on numbers, right? So he's right in regards to that. Let me answer. First off, we're at 3.1, right? I know the market really wants a 2 number, and hopefully we get that in the next month or two. And I wouldn't be surprised if we do. But we're at 3.1. We're right where we should be going, and that's the good news. But let me answer this question, because I'm sure it's on people's mind. Will the Fed consider raising rates higher, right? And the answer to that is likely no, unless we go back over 4 for CPI, which would be seen as, inflation's back for real. Coming in at a 3.1% number, no one's still scared of inflation. But if you all of a sudden hit a 4 and a CPI or above a 4, that's when everybody would freak out, and that's when the Fed would have to not only consider not lowering rates, but potentially going higher, right? Which would cause a lot of, let's just call it drama in the market. I can tell you that much. Next one up here, many consumers are out of their savings right now. Okay, let's hear this, folks.
Says that the Fed's wait, then drip strategy on rates greatly increases the chances of a recession. Joining us to explain is Campbell Harvey, professor of finance at the Fuqua School of Business at Duke University and director of research at Research Affiliates. His model for predicting recessions is 8 for 8, and he says it has yet to experience a false alarm. And what is it signaling right now, Professor?
So the inverted yield curve model is 8 out of 8, but importantly, without a false signal. And it is signaling slower growth and a recession. And I'm hopeful that plays out in a soft landing, which would be reduced growth and a mild recession, something like 2001.
How long between the initial inversion and have we already gone past historically the period of time when we were already supposed to be seeing a slowdown?
So no. So on average, the lead time is 13 months. And right now, we're just into the 15th month. So we're around the average right now, and it's far too early to say there's a false signal here.
Really? Where would we start to see some cracks developing? Because I think we thought we were seeing those 6 months ago, 8 months ago. Some people, Barry Sternlicht, thought we were seeing it a year and a half ago. And then suddenly things seem to accelerate. And I read every day on different websites that the economy has accelerated in the last 3 months.
Yeah, so it is confusing, and it always looks good before the slow growth actually starts. And what happened in 2023 was fairly simple, that the economy was driven by the consumer. So there was pent-up savings from COVID, and there were very generous government programs that injected money into savings. Those savings have been drawn down. So we're at the point right now where many consumers are out of their savings. And you can tell looking at the data. Look at auto loans. Look at credit card loans. Like if you're paying 20% interest on that, your savings have run out. On the business side, investment was already negative year over year in 2023. So those are significant headwinds. We've got commercial real estate. We've got a massive drain of deposits from our banking system because our banks are paying almost no interest.
Okay, so a lot there, right? We just got all the big tech earnings. What do we see from the big tech earnings? We actually saw an acceleration of growth for pretty much all those companies, which it's hard to say, things aren't well when there's a big acceleration of people buying stuff, of companies running ads because people are buying stuff. When Meta just reported a massive acceleration in their revenue growth. They just reported a 25% number in their last quarter, right? That's not happening unless people are out there buying stuff and businesses are enthusiastic about advertising, right? It doesn't happen. Google saw a nice acceleration of growth. You can look at even Amazon starting to see an acceleration of growth, especially on the e-commerce side. So all those are signals that, if anything, the consumer's getting in a little better spot than they were, right? Which makes sense, because if you look at the way wages have been rising recently versus where inflation's at, we're at a much healthier point in time where real wages are starting to increase, right? So, I don't know, looking at something like auto loans, I think is a really bad indicator, because a lot of people don't want to take out auto loans right now. Yet you look at the automakers and they're actually reporting pretty impressive numbers outside of Tesla, really.
Into money market funds. And what that means is less capital available for loans. And this will play out into a credit squeeze in 2024. So there's many headwinds here for 2024, but it doesn't feel like it right now. The first quarter, and especially, in my opinion, the second quarter, are going to be key. But what is pivotal is what the Fed will actually do. And when you said drip, 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 I just see that they are mistaken in reading what the real inflation rate is. Inflation has been within their target for the last year, but they're not seeing it because of the very stale shelter data that is skewing our read of inflation.
Could be fair, but the whole story is the Fed's going to screw up. Well, I mean, they always play it too long. I've been saying this for a long time now. They kept rates way too low for way too long, right? Then we had our massive inflation run. They're going to likely keep rates too high too long. Then we're going to have a downfall from that, right? It's the same old story with the Fed. They pretty much never get it right. So, in terms of their timing, they usually play it too long on both sides. And it is what it is.
Let's want to bring in